Hi, everybody. We are about to start, and let me see. Okay, yeah, our esteemed host Kusta is here, so we can start our welcoming session. So, ladies and gentlemen, esteemed guests and valued participants, welcome to our highly anticipated online conference. We're delighted to have each and every one of you joining us today as we embark on an insightful journey into the world of venture capital and investments today. Your presence here is a testament of your dedication to stay informed and engaged in this dynamic industry. And throughout our conference, we aim to provide you with value insights, thought-provoking discussions, networking opportunities that will enrich your understanding of the industry. So thank you for being a part of this enriching experience, and let us make the most of our time together. First of all, let me introduce the hosts of today's conference. So my name is Igor, and I'm a general partner at Contribution Capital, which is a leading US-based venture capital fund specializing in supporting startups in the Web3 infrastructure industry and blockchain space. So we are a pre-seed and seed fund, invest small checks in many US-based, Israeli-based, and worldwide like Web3 tech startups. And we're very proud to be hosting this event. The second host is Our Crowd, which is a renowned Israeli-based VC conglomerate known for its pioneering investment platform, connecting investors with promising startups. What's interesting about Our Crowd, and we're going to talk about it with a general partner of Our Crowd, Ron Stern, later on. What's interesting about them is that they started the journey in Israel as a syndication platform, and then they turned into a VC fund plus syndicate platform. And that's absolutely amazing transformation experience. And we're going to ask Ron about the journey, about the vision of the future of venture capital investments and 2024 investment landscape. And last but not least, it is the finest Bay Area, a dynamic VC ecosystem based in Finland, founded by the creators of Slush, Angry Birds, and other great companies. And they foster innovation and entrepreneurship in the Nordic region. So together, we as hosts bring a wealth of expertise and experience to this conference, offering diverse perspectives and invaluable insights to the world of venture capital. So thank you for you spending time listening to me. And I would like to ask Kusta, who is a partner from Finest. He's now here online. Kusta, please, if you will, please introduce yourself and the Finest Bay Area and what you're doing, in 2-3 minutes. Kusta, are you with us?
Yes, I am. I can't turn my video on for some reason, but you can hear me. So I think you're controlling the video. So
okay. Huh? How to let you with the video?
That's okay. Maybe I speak and you figure it out as we go along.
Yeah, okay, go ahead. Yes.
So first of all, thanks for inviting me to be part of this, and I think it's a fantastic topic that you've picked out. Very very current topic in many ways. But hey, my name is Kusta Valtonen. I'm from Helsinki, Finland, and we have started this company called Finest Bay Area Development with my business partner Peter Westerbacka some years ago, and The intention is to do regional ecosystem development through the company, and it's basically to boost the activity that has started. Okay, now it's works. That we have started more than 10 years ago in Finland, where we basically started to change the mindset of the whole country and set up functions like Slush that was already mentioned, world's probably biggest startup event, taking place always at the end of November in Helsinki when it's cold and dark, and maybe not the most obvious place for people to come to meet interesting startups and do investments, but the thing is that it is different. And last fall in November, I think we attracted 3 trillion of capital to Helsinki at Slush, and it has a very, very big impact in our region. So what basically we have started out is to kind of change the whole region's mindset and becoming more entrepreneurial. And the kind of results are sort of showing that Finland, Estonia, Sweden, Latvia, Lithuania, Norway are doing really well on global scale, creating startup companies per capita, attracting venture capital per capita, and creating unicorn companies per capita. We always need to add the per capita because we're all small nations, but that's a good metric to track the performance. So that's basically what we are doing. So investing in early stage companies, innovation, and nurturing the ecosystem the best we can. So really happy to be here, and I'll be part of the panel that starts in a few minutes. So you'll hear more of my thinking at the panel.
Yeah, amazing. Thank you, Kustaa. So a couple of words about this conference agenda, and we start our first panel then. So I mentioned contribution capital, finest Bay Area, our crowd. So what unites all of these hosts is the fact that we are providing retail investors with exciting opportunities to invest in venture by means of VC funds or syndicates that we manage. That's why this conference is dedicated to this topic, VC fund versus syndication platform investment, right? And let me outline the current market pain, and I take prominent platform on the AngelList as an example. So AngelList, as you may know, allows to launch VC funds or syndicates throughout the platform. Now, to anybody who wants to. So far, people who manage funds or syndicates on AngelList platform, they have more than $15 billion under management on this platform alone. In 2022, it is the last year where AngelList's public report is available. In 2022, investments made via VC funds and syndicates on AngelList almost caught up to approximately $1.3 billion and $1.2 billion correspondingly, meaning funds invested 1.3, syndicates invested $1.2 billion altogether. So for the first time in history, they equaled. The number of LPs, limited partners, investing in syndicates on AngelList platform grew 10 times in just 5 years and counting. Okay, during the same 5-year period, more than 8,000 startups, astonishing number, more than 8,000 startups in 5 years raised funds through AngelList platform, and mostly by syndication. Okay, and the volume of funds deployed actually increased in 2022. So a number of funds deployed by investors to startups through AngelList increased by 21% in 2022, while the rest of the industry actually showed a 1.4% of decline. Okay, and some figures, okay, but they show this astonishingly strong difference between the industry 5 years ago, 10 years ago, only VC funds, and now when we have these syndication platforms that are growing in popularity. So this data clearly indicates the growing prominence of syndicates as a preferred avenue for retail investors to deploy funds in venture capital. However, the question remains, what is the optimal choice for you as an investor? Okay, investing in a VC fund, or giving your money to managers, or participating in startup industry via syndicates, okay, on a deal-by-deal basis when you choose the company to invest in, right? So we'll explore this crucial decision, indeed crucial decision for you, and provide insights on how to make a wise choice between the two options throughout this conference. And we have two panels, one keynote fireside chat, and one workshop, okay? The first panel is dedicated to the question how to choose a VC fund, what questions to ask, what metrics to look at, and these questions are addressed by professional VC managers and by investors. The second panel is about syndication platforms, the same question. So the keynote speaker is our esteemed guest from host from our crowd, Ron Stern, who gonna address the amazing journey of our crowd, how they get there, where they stand now, and the vision of Ron of the future development of the industry. And the last but not least, we have a workshop. I will tell my secret sauce on how to find the best VC team, because it is a paramount importance to find a VC guys who you have a chemistry with, okay? And then we have a speed networking sessions for those who remain conscious after these 2.5 hours of our conference. So without further ado, let's start our panel one, and I would ask the guests, our speakers, to introduce themselves. If I may, I start from left to right on my screen, and the first one is my close friend and partner, Anurag. Anurag, hi.
Hi, Igor. How are you? Greetings from...
I'm fine, Anurag. It's great.
Yeah, greetings from California. I'm awake early, and I'm still drinking my coffee. So yeah, Igor is my friend, and we were former colleagues at Fort Ross Ventures together. I can quickly summarize my background. I have about 25 years in Silicon Valley. I have been in 3 startups. I've never been a founder, but I've reported to founders or to the CEOs of those companies. We sold 2 to public companies successfully. The third was a very big failure, but you have to have one of those in Silicon Valley. I've also helped manage 4 venture capital firms, including the one Igor and I worked at together. The aggregate capital under management that I've helped steward is about $2.5 billion. And I'm currently the CIO of a small family office. A friend of mine sold a company 18 months ago, so we set up a family office for him. But what makes it more interesting than the typical family office is we have an attached venture studio, and that's where we spend most of our energy, because he's a inveterate entrepreneur. He can't quit, even though he's been successful. And then the last thing worth mentioning for the purposes of this panel is I'm a trustee for the San Jose Pension Plan, and I chair the investment committee here. In fact, in about 40 minutes, we have a board meeting starting, so I will have to leave when that happens. But we re-implemented a venture capital program during my tenure as chairman of the investment committee, so we invest in funds as well. So I wear 2 hats. I can be a GP on one day and an LP on another day. Yep, that's it, Igor.
Amazing. Thank you, Anurag. So the next in line, Nick. Hi, how you doing, Nick?
Thank you so much for having me. I'm Nick Davidov. I co-run Davidov's Venture Collective with my wife, Marina. We are a community of 120 engineers, founders, and angels investing together as a fund. We manage two funds. The first one's 32 mil evergreen seed fund. The second one is a 75 mil follow-on opportunity fund. We invest in repeat founders in AI here in Silicon Valley. I've been doing this for 16 years of my life. VC, been founder a few times successfully, a few times not so much. And I just love building and love early stage.
Wow. Thank you for that. Thank you for that, Nick. And by the way, we also are we're colleagues with Nick. Also,
Oh, yeah.
good.
Same, yeah. Advising Portworth, now R136 VC.
Yeah.
Took me, I'll memorize the number.
Thank you for that. So the next is Joachim. Joachim, hi.
Hi everyone. I'm from Amsterdam. So I'm Joachim. I'm a partner at a fund called Acrobater. We're a 25 mil, that is euros in this case, fund focused on pre-seed, seed stage investors. And what sets us apart in this part of the world is that we focus primarily on founders from, let's say, post-Soviet countries. So very much focused on countries like Ukraine, Armenia, Russia as well, but not in Russia, of course, anymore. But those founder communities, because they tend to sort of be overlooked at that early stage. A little bit less so today than we were when we started. My background is not in software, but it's more on the traditional side. Started my own biodiesel production company in Austria, which failed miserably, but it was a good learning experience. Did turnarounds both in the Netherlands, in Kenya, and then moved to the US, where I got involved more in the early stage ecosystem in Portland, Oregon. And then upon returning to the Netherlands, set up together with Bas, who might be on another panel, what is now Acrobat.
Cool. Okay, then. I guess that's it. I can give a couple of words about myself. I'm a moderator in this panel. So once again, my name is Igor, and I'm general partner at Contribution Capital, this US-based VC. Before that, I served as the investment director and principal at Fort Ross Ventures, where we worked together with Anurag, and it was a 5-year journey. We invested in 30 plus companies across the US and Israel, like B2B SaaS, mostly. And I have a pretty classical financial background before that. A CFA, a Berkeley School of Business, and applied math and physics degree, all this stuff. And I also I'm also a developer. I can write code from time to time. So, okay, I guess we're about to start this panel in time. So, dear panelists, let me start from this question. So, the main goal of this panel is to help investors to decide if this given VC fund is worth investing into, worth looking at or not. So what are the important key metrics that we all should ask the VC managers before letting them manage our money? And there are several things I would like to discuss. The first one is a so-called generalist versus specialist dilemma. So in today's venture landscape, what fund strategy do you believe holds the most promise? Specialist fund investing in some narrow range of startups, bounded by industry, geography, and stage of investment, or a generalist fund is better. So, and I would like to address this question to Kusta as a VC manager, and to Anurag in his role of investor in this case.
Gustav, would you like to go first?
Of course. First to the lion. So I'm a generalist myself, so I do believe in the generalist approach to funds. And the reason is that the sort of work life and life in general is very hectic nowadays. So lots of things happening very rapidly, and you're very specialized. So what can happen easily is that time passes fast forward, very, very fast, and you might be missing out on opportunities that otherwise might have been interesting. So I have to go with the generalist fund, and it just gives you more flexibility in kind of going to be successful. Anurag, please.
I'm going to hedge. The answer depends. Look, if we're a limited partner, there would be nothing better. Theoretically, there would be nothing better than having a bunch of managers who are all specialists, and so they are just they are experts. They are deep. They're spending all their time in just one area, and then at your portfolio level, you have diversification. But think about what that means for the managers. If they're in an out of favor sector, they may not be as motivated or as incentivized when things get really difficult, or it looks like the market conditions won't improve, where the fund can generate, a decent return, because you want your managers to have skin in the game and be incentivized too. So in theory, there is a lot of value in that, but you have to be careful, because you have to incentives dictate behavior. But I'll also address the question from a different perspective. When we say specialist, I think most people think AI specialist, robotics specialist, crypto specialist, etc. That's one form of specialization. If you have an angle on a community for deal flow, whether it's geographic or it's out of a certain set of universities, whatever it may be, I'm sort of making it off the top of my head, but really it comes down to the deal flow. So if you have a perspective on deal flow, and if you're a bit of a more of a generalist, then you have to also be able to marry that to a perspective on the markets, right? You find an entrepreneur doing XYZ, but you also have to make sure that they're pursuing an attractive market. The third thing I would say is, I think so I'm giving you three different frameworks, and I guess if we're making a manager selection, we have to think about all three at the same time. It's very qualitative. It's a heuristic. I don't think you can turn this into a mathematical formula. Mistake number one made by limited partners: they think that they can use the CFA principles for judging managers in the alternative asset class, and you can't. You have to have pattern matching and experience, and know how to ask the right questions at a very detailed level when you're talking to managers. But the third framework I might offer to this group is, for pre-A, there's a lot of value in having some form of specialization, because those entrepreneurs need so much help. And on the continuum of science project to commercialization, they're much closer to science project. They need someone to help them with that product market fit, the MVP. And so I think the more expertise that you have in a certain area and can help entrepreneurs over and over again and continue to build that knowledge network is useful. I think A and beyond, then generalist works, and typically you're looking for those funds to provide a different form of value to the company. Maybe they have a brand, a halo effect, so you'll have more people who want to come and work at the company. They'll have bigger networks for recruiting, et cetera, et cetera. Those are just frameworks for how you might think about specialized firms versus generalist firms.
Well, thank you. It's a very complex answer. And actually, I would like to ask Gustav about this, because together with Gustav, we are alumnus of a VC lab. It is a US-based accelerator for first-time managers, and I would say that the guys in VC Lab, they're all about specialization. So, Gustav, how did you manage to graduate and generalist?
It's not that complicated, and I think Anurag put kind of the context really well, that you can be both. being generalist, but you can be specialist in a certain other area. For example, the regional aspect. I think focusing on a certain group of countries or certain region, that's quite easy to understand. That you're kind of narrowing your focus and being specialized in certain sector, or working with certain schools or academia. I think that's quite straightforward from that perspective. So there's really no one answer to this one, specialist or generalist, but it's a combination of different elements.
Yeah.
But I still vote for the generalist.
Okay. The last question on this. Do you think this depends on the size of the fund? So like smaller funds, more specialists, larger funds, more generalists, or not such a correlation?
Well, if I can go first, then my business partner and I, we kind of started our journey that, okay, let's do big. We know how this is done, but then we kind of came to a point where we kind of started to look at that, hey, if we do smaller funds, we can be much more agile. We can react to market changes, different types of situations. And we kind of felt that smaller funds make actually more sense. But again, there's space for both, depending on kind of where you want to work in the startup ecosystem, which part are you at the beginning of the curve or kind of towards the later rounds?
Okay. Another topic to add?
Yeah, sure. I mean, I think implicit in my earlier answer was that probably makes a little bit more sense to be specialized at smaller. I mean, when you get to bigger funds, there's usually a partner that's more software-centric, more consumer-centric. The bigger funds tend to have a bigger team. So you get some specialization while the firm is a little bit more generalist. I think it's hard to be a really big fund at the really early stage if your goal is to add value and roll up your sleeve. Fortunately, and I don't know if you're going to discuss this on the panel, I think there's interesting technologies. We're all investing in AI, but we should all also be consuming it. I know Nick is. I should have mentioned I have two friends on these panels. So I know Nick is. And that can obviously help scale a portfolio. But generally, those are my thoughts.
Okay. Got it. So let's go to the next question then. Okay. So, which is about team composition, which is important. And the question formulates like this. What's your ideal venture team composition and background, considering investors, entrepreneurs, industry experts, etc.? Like maybe you think there should be a lot of operators and entrepreneurs on the team, or maybe financial investors are also important, and we need like one operator, one financial investor, but whatever. So, and this question I would address to Nick and to Joachim.
So basically team composition is one of the most important, for me, decision factors, writing an LP check. I only wrote 2 LP checks in my life, so not a super experienced limited partner. Both times that was more because of the person who was running the fund than like the strategy or, the size or anything else. For me, the biggest question is like when building a team, how are we going to win deals? Because roughly the power law is real for deals. 80% of the deals are highly contested. They are sometimes successful because they are in the right time, in the right place, in the right community. It's easy for them to raise money. So they're not looking for money. They're looking for value. How exactly are we going to get our allocation? How exactly are we going to get our pro rata rights to keep investing if it's a home run? And competing for deals is hard. So for me, it's super important to have founders on the team. And since we invest in early stage, it's super important to have people who are technical on the team. With founders, there's a catch though. So they're good founders, sometimes are horrible VCs, when they get into this trap of looking at a company and thinking what they would do with it. So it takes a certain type of a founder who's more like a strategy person who looks at, and also like a people's person who looks at the actually founding team of a startup and thinks how they would do this, not like trying to put this, get in their shoes and try to figure out how, like what they would do in their place. But definitely would take founders over anybody else. There's so many career VCs that have like zero understanding of what it's like of being a founder, zero understanding of like what it's like being in their shoes. And being a founder is well, everybody talks about how hard it is. It's also about just knowing how to do stuff. It's a skill. It's a craft that can be taught, can be learned. It's not, fucking magic, or it's not something that people are born with. Well, some are born with a little bit more talents that are used for founders. So founder is technical. Anybody who has an experience investing themselves. So currently we have 4 partners in the fund. All 4 founders, all 4 technical, 2 worked in the big tech, 2 well, I technically also worked in the big tech, but I got fired from Cisco, so I'm kind of a little bit traumatized. But yeah, so I think if a fund invests on a later stage, that makes sense to start getting people who understand finance, who, would dig into numbers, who would look at stuff differently. But for pre-seed, seed, I don't think there's anybody else better who's other than a founder.
Okay, thank you. Very comprehensive. Joachim, anything to add?
Yeah, so let me also first start by framing the answer. So I'm assuming that most of the audience is not going to, it's not contemplating, oh, should I put money in KKR or some massive fund? So the more likely what they're focusing on either putting checks in angel syndicates or in smaller VCs. So that's how I'll answer the team composition. So first of all, I completely agree with Nick. You need people on that team, or at least one partner that is highly proficient on technical matters, that was either, a founder, a CTO, a researcher that really understands technology. And even more so today, where you need to be able to distinguish whether something is just a wrapper or has actual longevity potential, or, is going to be irrelevant day after tomorrow. So someone that has not only an understanding, has built things, so has also the ability to judge the competence of technical teams just based on, asking how they make decisions, for instance. I mean, I can't do that. Like a technical team can tell me whatever, but I know that my partner Ramon, he can have a conversation with them because he's been a CTO for 12 years, over 100 projects. So that capability, I think, is crucial. Then also to Nick's point again, the operator experience, right? Whether it was in a tech startup or another company, to have, being both the CEO or CFO and the person responsible for taking out the trash, like you have to have lived everything and got your hands dirty to and that creates what also I think in our view very important at that early stage is empathy. Like you have to be people centric. You're dealing with usually very young people, maybe sometimes not very experienced, but you have to have that level of empathy to rebuild a very trust-based relationship, because otherwise the companies you invest in will, not show themselves for a couple of months until things go wrong, and then it's too late to actually be able to help. So that's where we focus on very much as well, on the coaching side, on the relationship side, and be very articulate. And that's sort of when you're judging a team, I would ask them sort of what are the 1 or 2 things you really as a team excel at, to the point of winning deals. Like we can't pretend to do everything really well. Everybody has a network, but can you actually show what it is you do extremely well, and have founders that back up that story.
Okay, amazing. Can't agree more. Okay, right. So my next question would be about secret sauce. Another thing we learned a lot in VC Lab, and everybody speaking about this. So when selecting a fund, this might be very crucial. The secret sauce, meaning the question I would formulate: if you were an investor who choosing a fund, how would you recommend to look at its unique strength? And what is your fund's secret sauce? How it's important? How was it important when you onboarded your first, second, third limited partner? And what was this secret sauce? So once again, Kustai, Joachim, go ahead. Kustai, now you had a secret sauce for sure.
Sure, yeah. So it's easier to kind of evaluate the GPs when they are doing their second, third, fourth fund because then there's existing track record, so they can show the performance of the fund, what they've accomplished, and so on. So that's kind of well, there is existing data available, so that's what you ask for, and evaluate the performance, and of course your secret sauce can develop over time, and you can find sort of new ingredients into that. But I think the interesting part is kind of the first fund that you are doing. So how do you show that? What is the strength or the uniqueness of your GP team for that fund, and there I think it's the track record. So kind of that's what you have to show for what you are planning to do or what you've set out to do. And kind of if I look at our team of two, so we have a lot of expertise in the startup domain, in the investment domain. So for example, myself, I've been a full-time business angel for like 12 plus years. We run already a portfolio of 60 startups, and we mentor another 60 maybe. So we're kind of hands-on with a lot of the companies and kind of going through this. So that's kind of developed into our team's secret sauce, and that's kind of the stuff that you're looking for from all of the other GPs working in this space.
Right. And also have approached this thousands of participants of Slash, all this ecosystem participants we have. That's definitely a great thing to have. I mean,
it's a big asset, but maybe it can be part of the fund's secret sauce, because that's the place where you find the best talent and skill. That's where the startups go to find funding. But it's more of a platform for doing things. So it's kind of how you use that platform. That's I think the secret sauce.
I think of it when I'm an LP and I'm just comparing two different funds. The first one is just like I'm a generalist fund. I do not have anything to add to this. I'm going to manage your money well, okay? And on the other hand, you have a specialist fund, like investing in Nordic companies, like yourself, right? You say, I understand very well these startups, these founders. I have like 5,000 plus startups attending my online event every year, and I'm gonna invest in the best, the very best of them. I mean, for me, it is very important to choose, right? Just somebody and Kusta, right? So
yeah, that's because the startups already there are qualified somehow. So you're kind of getting a funnel that's capable of digesting quite a lot of companies, and you get very well qualified companies at the end. So.
Yeah, indeed. Joachim, your turn.
Yeah, so I think when you're selecting or looking or interviewing GPs, like everyone already said, in the end, it's all about access. Can you get to deals, good deals? And then usually they have a focus, whatever it is, whether it's regional or some technologies or markets. So try to figure out how well do they actually have access to that market? Can they show that? So in our case, when we started, basically was access to overlooked founders of this CIS originating founders or the diaspora of it. And how could we back that up? Well, first of all, we had Bas, who was my original partner in the fund, who he's half Ukrainian, half Dutch, spent years in Russia, spent years in Ukraine, angel investor, invested in a couple of really cool companies already for a long time. So that gives you track record. Even though it's not a high frequency of investments, he was there. He's been, was visible on all kinds of events. Then we had Mike, who ran the first 3 batches of Startup Wise Guys in Estonia. Lots of exposure to the region. And then from my side, not so much on the tech side, but from my family side, we've been investing in that region since 1991. So we've got very long, very deep relationships across the region and affinity there. So that combination then becomes credible, so to speak, even in the absence of real track record, although Mike and Bess definitely had some. So that was one element. And then I think it's also, especially with emerging managers, you have to realize that just like a startup, they will also evolve. They will sharpen, they will, do micro adjustments on what they think they should be investing in. And the team is to be capable of doing that. And that's where, for instance, having Ramon on our team was crucial. It is someone with, has been in machine learning for the past 25 years. So when we are looking at research and technologies, like he has a perspective that very few others have. And also when we talk to founders, they finally have someone they can really, talk to, so to speak. So those were the 2 elements of our secret sauce, and also ones that we could back up. So if you are selecting a GP, going back to ask them what they are going to excel at, what they can do really well, better than someone else, so they can win those deals, and then find data points to back that up, whether that's direct, like, literal investments in the space, returns, actual returns, not paper ones, because we all know how fickle they can be, but also sort of other data points that give credibility to that story.
Okay, fair enough. Okay, nice. Let's go further. So the next question is to Nick and Anurag, and to you too, because I know you have probably different views on this one, and that's gonna be interesting to listen to it. And it is about stakes in startups. So, in investment strategies, some funds opt for significant stakes and active involvement in board of directors, etc., while others pursue smaller stakes in leading deals. When you have a top tier 1 leading fund, and you join as a smaller investor because it's a good deal, you do not have to spend much time managing on the board, etc. And that equally good, but it depends, right? It depends on the size of the fund and on your strategy. So, Anurag, what do you think?
You want me to go first? Look, I already said this in my first answer. I also gave it depends. So I'm going to come across to the audience as a wishy-washy person who can't make a decisive. But these things are not, they don't fit into neat boxes. We can reference our own experience, Igor. When we were at Fort Ross, it was a brand new firm with no brand, no track record, no pedigree in Silicon Valley. And I think the premium was to invest with really good syndicates. and show them our capability, which essentially was accessing the Eastern European market. A lot of great technical talent that we were able to bring into portfolio companies. And then we were able to open a market as well because one of our main limited partners bought technologies from startups, which many big corporate banks don't do. So, for that strategy, it made all the sense in the world. And plus, I think I can say this, Igor, I don't think it's inappropriate. Much of the team at Fort Ross was a bit newer to venture capital. They had been successful in other aspects of their career that were useful to helping portfolio companies. So, learning alongside some of the better venture capitalists also made quite a bit of sense there. But, if you're in the earlier stage, and, you've got a real good perspective on a company, a market, you feel you're bringing a certain set of skills, whether it's specialist skills or some of the things that Joachim talked about, that your partners can bring support. Leading the deal and being in the driver's seat alongside the founder in the company building process. I mean, I'm the most, I'm a procrastinator, so I'm the most stressed out when I'm not doing work. And then all of a sudden, when I crack open my computer and start, even if it's 2-3 hours of work I have to do, I'm immediately relaxed because I'm engaged and I know the work's getting done. And when you're a lead, you can feel that same sense of involvement.
I agree with about what Ross.
And maybe control is another word. Maybe there's some benefit to feeling like control is as some spiritual people in the Eastern philosophies will say it's an illusion, but sometimes it's a satisfactory illusion.
And yeah, it's we have a different strategy. We opt for smaller stakes. I know. So ownership, basically, let's try to walk the logic backwards. Yes, ownership is the name of the game if you're investing on later stages, and that's if you want to make money in early stage, you have to start early, but the majority, like the biggest part of the money you make, the biggest volume you make is still made on later stages from follow-on investments. And basically, by investing early, you're just getting access into the deal. So ownership is the name of the game, but the market is really not the buyer's market. It's the seller's market when it comes to the very, very, very best startups. So if we try to put ourselves into founder's shoes, and let's say, hey, I'm a founder of a company that really has found product market fit and is attacking a huge market. Let's say Perplexity. That's a good example of a company we invested in. There's a very long line of investors that are trying to put the money in. What would a founder do? Would they rather take somebody who's gonna occupy a large chunk of their cap table and squeeze everybody out? Or would they try to get more value-added, smaller stake investors? Definitely the latter. They would if they have the resource, if they have the bargaining power, they'll definitely go to optimize for the smaller ones, because it's not a given that you're going to have chemistry with somebody after 3 years, 5 years working together. It's not a given that they're going to be helpful. And we are super helpful, but sometimes we, even in our portfolio, there are companies that we did nothing for. It's one of our portfolio companies just raised a $40 million round from Kleiner, and they didn't take us in because we were unable to help. For some other companies, I think they believe we're their they're guardian angels or something, because we brought their first customer, we brought their first engineer, we brought their next investor. They love us. But for some, we're useless. So a good founder will always optimize to have more shots at it. And so for us, it just makes sense to offer smaller checks, not to be, dwelling on the idea that we have a shareholding criteria, you have to have 15% of the company. If we are able to help, if we're able to create value, they will allow us to increase our share down the line. If we put our foot in the door with a $200K check, we can invest $500,000, we can invest $5 million down the line. That happened before. So this is what we do. Another reason why we don't take large portions of companies, that I never want to sit on the board. Doesn't mean that I don't want to spend too much time with the company. I do spend that much time with the company. I just don't want to sit across the table from them. I want to be on the same side of the table because I'm solving, as a VC, I'm solving two things. I'm solving access and information. And sitting on the board across the table from the founder limits my access because I have to be like, if they are doing something I don't like, I have to be the dick. I have to tell them no. And like, that would hurt my relationships with the founder. I'd rather just like let people sitting on the board say no. And then the second thing is that information on the board is more limited than if a founder calls you and says, hey, I got a board in a week. This is what I want to get from it. This is what I got. How do I put it in the presentation? And then you have all of the information in the world. So if taking smaller, chunks in the beginning makes sense for your fund or like for the fund you're investing in, I think go for it.
Yeah. Thank you.
Yeah. Can I just want to jump in because Nick and I are friends, so I don't mind interrupting him, but I probably wouldn't interrupt the others. Everything he said makes 100% sense when you're a smaller fund. I mean, and he said it at the beginning of his remarks. When you're a bigger fund, you have to be ownership conscious. You have to model and construct your portfolio totally differently. I don't like sitting in board meetings. I'm about to start one in 15 minutes. They're long. People say things that aren't useful. No one problem solves at the end of the board meetings. They just tend to be a report out. That time can be much better spent. And building those individual relationships with your founders is ultimately what matters anyway. But Nick both has a flexibility and also has a personal style that allows him to be successful with that, which matters because there are many VCs who can't do that. And there's also a lot of VCs who have to worry about governance. I mean, they've raised money from people like San Jose. And the one thing with the gray hair I have, and I'm also starting to lose it a bit on the top of my head, is I've lived through 3 market downturns now, and governance has consistently gotten worse in Silicon Valley. In fact, it's non-existent. When I was first entered the business, the VCs had all the power, and being the nice guy on the board, so the CEO would call you outside of board meetings to get honest feedback instead of just getting beaten up, was pretty common. As to where now, I know top-tier VCs that barely do their fiduciary duty, in my opinion, in their companies, and there's so many examples of them. So, at some level, and I'm going to say this very gently, I hope in all of Nick's companies, as they become big and they grow and they need to get the bigger checks instead of $200,000 checks from 50 people, the funds that provide that are also providing some governance because someone has to do it. So, and good to free ride off of it if someone else is doing it, because I don't want to sit in those 4-hour board meetings either.
Yeah.
Sometimes it goes sideways. You're right. Like I had a situation with Insight Partners once where like a career VC was just steering the company in terms of governance, steering it into the ground, and influencing founders in a very bad way. But because she was on the board with enough power, they had to kind of listen to her, and that was super hard to manage. We were kind of helpless. We're a small investor. So
Yeah,
you're right.
You don't want to. You hope Insight doesn't come into one of your deals. I'm willing to say that out loud.
Much money.
Too much money, and they came and polluted our ecosystem along with 3 other big funds.
Okay, Joachim raised the hand, and
yeah, I think it's a great topic, right? The board and influence, and I think the reality is like young companies need a lot of outside advice in a way that they can actually use it in order to not make silly mistakes that can be avoided. Like one of the things we try and do from day one, and back in 2019 and 2020, it wasn't very popular that I did it, but like, guys, do you understand what your gross margin is? Like, you're still building a company, right? Money matters. And the way we see it is we do take board positions consistently, but we see it as a way, like, very clear with the objective. For us, the objective is that by Series A, the relationship we have with the founders is as if we're sitting on one side of the table. so that we can be that sort of support to them throughout their journey with larger investors coming on board. And that's, that's a little bit how we do it. And then, it's also, of course, the fund model, right? The way our model works is that we require a certain ownership because of how we invest. But it's a delicate balance sometimes.
Yeah. Okay. I have so many questions, but not enough time. I'm trying to understand what to ask. Okay. Maybe a very quick one. Just yes or no. Delaware or not Delaware? Everybody.
Follow your investors. My investors are not from the US, so why should I put something in Delaware?
Here, Joachim.
The same, Costa, right? The same?
Yeah, I like Delaware, but my investors are from Europe.
By the way, like our construction is a Dutch cooperative, which is actually what the Delaware is based on. So it's basically the same.
And I am not asking Anurag and Nick.
Yeah, goes without saying. Yes, Delaware.
Yeah, yes, Delaware as well. And I believe that Delaware hosts the most amount of assets under management in the world, and hence you have like a lot of infrastructure there. So
I used to be total 100% Delaware bigot, but now I'm 75%.
After Elon Musk, right?
Well, I mean, look, the combination of U.S. capital markets and corporate law and governance, I just haven't found any jurisdiction that comes close. But you do have to follow the founders. But my bar for following international founders is super high, and I have to do it through expert networks who are local, like Acosta or Joachim, or a group I invest with in India and in Singapore. I mean, I just have to rely on them and then cross my fingers on the legal.
Okay, and the last question. I wanted to ask you to name like top 3 metrics when choosing a VC fund, but I guess we have no time. Just one. Name one top metric you would look at or recommend investors to look at when choosing a VC fund, but only if nobody else named it before you. So, who would be the first one?
Let's do a non-metric metric. Founder feedback.
Founder feedback on the managers, right?
Yep.
Yeah, my answer is 2-part. For earlier stage, it's pretty much what Joachim just said. I mean, I would probably, if I were to turn it into a metric, it would be what their founder network looks like. And I would want some evidence metric proof, and not LinkedIn, because a lot of people are promiscuous on LinkedIn. And if it was later stage, I'm sorry, the name of this game is distribution of capital, and it would be DPI, which many top firms have not produced. Some of the best brand name firms have really meager DPI. So don't get seduced by brand names. See if they actually return capital.
Okay. Costa?
I think it was a good point about the quantitative versus qualitative metric that I think very often we forget the sort of verbal feedback and so on. But if we need to name one, I'm a big fan of the multiples on invested capitals. So that's an easy one. Good indicator.
Okay.
DPI and DPI have been taken, so I'll say fund size. I'll like most of the good funds I know are small. Mm-hmm. I'm yet to encounter $1 billion seed fund that is returning good money to its investors. So I think staple seed fund, like the best seed fund I've seen in my career, is Mike Maple's Floodgate, and it's under 100 million size.
Yeah. The smaller funds, I have the data now because of 5 years of this other hat I wear. The smaller funds outperform the brand name firms, the big firms, all day long. It's just that there's thousands and thousands of little firms who are essentially pitching the same thing in their 10 slides. And most people don't have the sophistication to pick among them. It's really hard work. But if you're lucky enough to pick the right smaller funds, then you have a chance to get real venture returns. Otherwise, I'll be controversial to end my time on the call. You shouldn't be in a venture fund. You should be in the triple Q. The Nasdaq triple Q over the last 10 years did better than the top quartile venture returns.
Yeah,
Definitely. Yeah.
okay then. I mean, we're at time, surprisingly.
Thank you very much.
And yeah, thank you, everybody. I see the participants from the panel too are already here. So everybody, I'm making you attendees. So feel free to stay with us. And we are about to start the new session in a couple of minutes.
Thank you, Igor. Thank you, everybody.
Thank you.
Thank you. Bye-bye.
Bye.
Just 1 second. Yeah, I'm sorry, Kusta, I'm making you an attendee for this time because we need on the speakers on the screen. I guess we can start actually. I mean, the session starts in 5 minutes, but we can start from introductions. And Daniel Hestic here is our esteemed moderator of this session. Hi, Daniel. And I give the floor to you. Maybe you can start from the introduction yourself, and I'm going to mute. Please, guys, go ahead. You have 40 minutes to talk.
Okay. Hello, everybody. I hope you can hear me quite well. I do quite a big apologies for previous background noise, but I'll make my best over the question. I'm the Daniel Hestic partner of Tensor Ventures, which is one of the biggest tech funds based in Dallas and provinces in Europe in Quad, roughly 60 million. And moderator today, which is amazing. Welcome.
Cool.
Yes, please. Who's going to be next? I can go next. I already made my introduction of the panel one, but I can continue here to read here. So my name is Igor. I'm a general partner at Contribution Capital. It is a VC, US-based venture firm. We invest in Web3 infrastructural startups, primarily in the US and in Israel. Our sweet spot is pre-seed and seed startups with strong teams and good leads or co-leads in the deal. I have a pretty engineering and technical background and 15 years of experience in investing, investment banks, private equity, and last 7 years I've been serving as investment director or partner in the VC industry. So who's going to be the next?
I can go next. So, and I will let Murat then if it's possible. So this is Ali. I am a managing partner in Grow in EMEA. Grow in EMEA is a company working in the startup investment scene in last 9 years. We do B2B SaaS investments mostly, but also we are a shareholder companies in like Bolt, for example, a biggest car sharing company, and some B2C domains as well. But our main focus is B2B SaaS, fintech, and RegTech startups generally. Thanks.
And I'm Murat. I'm serial entrepreneur. During last 30 years, I'm in the venture industry almost 9 years, like super angel, up to invest about 48 companies, 12 exits. My background, I'm engineer and
core business at telco?
Hello, I am Bas Gotska. I used to be a digital Dutchman in the former, like in Russia and Ukraine and everywhere, and then became an angel and then set up Acrobator Ventures, which is a Dutch 25 million fund. We do pre-seed, seed stage. My soul is, I would say, an angel investor, but my institutional approach is VC, and we focus mainly on tickets, I would say, from about 200K to 2 million into cybersecurity, fintech, infrastructure, synthetic media, data-heavy technologies, and ad tech. And we invest this in Eastern diaspora founders coming from the East worldwide.
Cool.
Yeah. Hi, everyone.
Nick.
Yeah. Hi, everyone. My name is Nikolai Denisov. So, yeah, I'm a healthcare entrepreneur. Spent 20 years in healthcare business. Know the field very well. So now I'm an active angel investor, and I'm running a big syndicate of angels called Angels Deck with more than 130 companies in portfolio. So we do early stage investments, pre-seed, seed. Now we're focusing on seed, late seed, Series A. So physically, I'm living in Dubai for 3 years. So we do investments in MENA region also. Well, we have a lot of talks about MENA region and what is happening here. So yeah, also active investor, more than 45 companies in my personal portfolio. So yeah, happy to talk about VC and senior syndicates. We know the stuff.
Okay, well, thank you guys for the introduction. And we have some interesting questions for the audience. And the first one maybe would be for Nick or Bas. The situation is changing on the current venture landscape, right? And which strategy for you and maybe for the fund you work for is more effective? Is it more being specialist, based on the domain or the geography, or more like a general? You see a lot of shift from generally being more specific. So if you can take some points on this, what would you recommend?
Yeah, it's interesting that when you Google a bit, you get the stats, or when you validate about close to 2,000 VC funds in the last 20 years, then actually generalists seems to be outperformed by specific. But when you look at the last 5 years, actually no, I would say till about 2 years ago, then specialist funds seem to perform better. But it's all a bit kind of, you even get stats here and there that contradict, as usual, I guess, a bit. But I would say that as a rule of thumb, in harder times, the specific funds under 250 million, they perform better. And when we zoom in on how I would look at it as an investor, now you asked me like as a VC, right? Now I also have 50 investments as an angel, and now I wonder which cap to wear. Like, shall I answer as a VC or as an angel? What would you prefer, Daniel? If you can hear me.
Well, I guess we're talking on behalf of the angel. I mean, rather like venture funds, to be honest, because I guess the angels are more specific type to the domains, or better treat kind of a strain data in.
We can't hear you, Bas.
Bas,
Oops, yeah, sorry. Yeah. So I would say as an angel, you should benefit from your specific knowledge. I myself have been a growth marketeer, and this was exactly what startups needed. So it was smart money. I think that's the compelling success factor, the secret sauce for an angel investor to add something extra to the table. As a VC, you could say that this is also the case, but in a market, when you speak to founders in the last few years, with definitely funds drying up to invest, I would say founders will say, just grab any cash you can. So when you look from the LP side, already came up with how the overall stats show that in good times, generalist funds perform better. When it's a bit harder, you deconcentrate into more specific funds. It's funny that with our fund, we raised both during COVID and when the war started. So people liked our geo focus that was for Western investors. We have mainly European investors, some American. They were happy that we covered a niche that no other fund or not many funds at the time were tackling, pre-seed seed from the Eastern diaspora, but as a Dutch fund. It was also interesting from stats that on all the emerging funds in Europe, only 4% would invest outside Europe. So that specialist niche made us able to differentiate between all the other funds. So I hope that those data points give you some insight in how I look at things.
Yeah, I do agree with Bas in a lot of things. So I also let's divide also as an angel investor. So yes, I was trying to focus on healthcare, on medtech, as far as I spent 20 years in this business, and I've seen a lot of like startups on the field and so on. But then I do realize that I'm still missing, a lot of very good opportunities, and so that feeling embarrassed me a lot. So yeah, and even in my angel career, so I switched to some other sectors, so because I see the world is moving so fast, and I like healthcare, so I do understand the field, and I do understand regulations and so on. But anyway, so even as an angel, I can't miss other opportunities. So as a syndicate, actually, that's a great question. What is good? And we had these discussions at our meetups in Dubai a lot, and I had these discussions with the local VCs and the US VCs. What is better? So as a syndicate, we can specialize on something specific. So anyway, we had to be generalist because that's a kind of business, So we're trying to co-invest with other guys. So we have several partners with different knowledge and so on. So it's actually our strategy. We have more than 100 investments, and we're trying to catch as much good companies in different sectors as possible. So from this perspective, so for us, like the only way is like to be some generalists. But I do realize, and I do agree with Bas that especially in crisis, specialized funds they performing better. Yes, and I also feel it as an LP, as another in my head. I'm personal LP in 4 funds. I'm also trying to put some checks to some specific specialized fund. And actually, but once you are thinking about running your own fund, for example, that's also a great question. I think the fundraise for the fund, if you are generalist, it's much more harder, because there's anyway, you need to have some specific stuff. But I think anyway, so it's still arguable, but talking about syndicate, I do believe mostly in generalist model. So that's actually what we do.
Okay, thank you guys. And that leads me to another question. So when you talk about generalistic approach for syndicates, so assembling investors for investment, would you be rather open to have the open marketplace of deals where it's created by some kind of syndicate investment committee, or would you rather have some kind of platform like AngelList or Friends of Friends approach? What would be your take? Like which direction would you prefer? And this question can go to Murat first, and maybe then Nick.
Okay. From my point of view, that question is in some of competence of the angel.
who will take part in the syndicate. If this, how to say, fresh angel is not experienced, of course, it's much better going to the syndicate, which syndicators who have experience and which can do good due diligence of the company and give some, how to say it, warranty of the quality for the project. It's a main reason. And the second question that it's actually I don't see the open market and marketplace for startups at all. Some attempt I saw, but in any case, it's required many questions to how to access to this startup. Therefore, this question is, from my point of view, it's much more evident in terms for the special syndicate. But of course, from my point of view, it means that as an angel investor with huge experience, of course, if it's would be accessible, this marketplace, I take part with pleasure, of course. But I can't see it. Maybe somebody can see it, just a share for me. Thank you.
Actually, I don't believe in any form of open marketplace of deals. Frankly speaking, we did hundreds of deals, and I see that full democracy, in that space doesn't work at all. So anyway, they needed some kind of guidance in this area. So, and actually that's actually what we do promote, what actually we do. So I think there's should be the system that validates the ideas, that yield the ideas. That's why like 2-3 kind of filters, before the end investors they can commit to this deal. Because of course, we see a lot of opportunities and a lot of startups that are still appearing and a lot of investments available. But actually that's what we do, this type of collective investments, when as a partners we can validate the ideas, we can reveal ideas, and then we decide that we will bring these ideas to the table. We can put ourselves some skin in the game to these deals, and only at that moment we will offer these deals to our angels, and then even then they won't, if they won't participate or not. So and we do believe in this 3 stages system when it works itself, and so that's actually what we do promote and do believe, because all the investments that our angels will do directly or in some kind of open marketplaces where it's not validated properly. So we do believe it's waste of time and waste of money. And actually, I agree with Murat. I don't know open marketplaces, even in Angel List, there is this marketplace for syndicators. Once you will see an open marketplace with syndicated who offer these deals anyway. You can see the person who's a deal captain, who's preparing these deals, and that makes sense. But not open marketplace for sure. But even better, even 2-3 some layers of this, check up on the startups, what actually we do.
Okay. So in one sentence, what is the primary deal source for you guys? Just in one sentence, where do you seek the deal from? Network, angel networks, personal recommendation.
From me, that 80% of the deals is coming from the warm leads from my network. Mostly it's venture investors worldwide.
In our fund, it's about 50% is referral, and 50% is either outreach or inbound without referral. And personally, in the 50 before the fund, I think everything, there was zero outbound. It was all passive inbound in the sense that I would just look at what would be introduced, and the majority, same as Murat, would be referrals or startups that found me at a conference or something.
Yeah, I would say I would try to be even more specific. Of course, referrals for us also the majority. I would say like from the I think 30% comes from our angels that co-invest with us. So from our members, 30% comes from us, from partners, from our network, and 30% comes from our portfolio founders. So once you invested already to 100 companies, so also, and maybe only 10% comes inbound, and some kind of also like WhatsApp and conferences, some kind of our own research, but that's about us.
I need to quickly add that I was talking about numbers based on the deal flow, not on the actual final selection. That data I don't have ready now on the top of my head.
Okay,
thank you. And now we have a question maybe to the audience. Figure out, like, when you have a lead investor, and you demonstrate the commitment, do you think it's a good idea to actually retire some kind of minimal level participation from a deal start? So you kind of indicate the willingness to invest, or it's a kind of rather like agreement between all parties that involves the bid to the deal?
Yes. Maybe I can start, and I can say that once I start making angel investments or seed investment, Series A investment, let's say in 2015, the minimum level, I guess, that time to lead a deal was around 40 to 50%. So if someone covers the 40 to 50% of the deal, then we count it as a lead investor on that time. And it's not just the financial side, but also time side. They manage and they make the deal from stretch to the ongoing level till maybe the COVID times, till 2020, let's say. But after 2020, after the investment seems getting a bit tighter, I think nowadays, last September, I joined a round which the lead investor covers the 25%, and there are some small groups there putting 10 to 15%, and there are angel investors, for example. So as the investors amount is getting increased, I think this number change. But I don't think that there is a very strict and very tight definition on this. It can be changeable by deal, but the main thing is who is making the deal, who is making the main negotiations, and who is making the preparing the environment is the case, I believe.
So what about Big Rat?
Yeah, thank you, Daniel. I think I will present myself shortly. So I'm Tigran Nazaretian. I'm GP at Contribution Capital. I'm also business angel last 7 years. And I have in my portfolio about 40 plus startups. Also have like 2 unicorns. So before I invested in Web2 startups, but when we started Contribution Capital, so now we focused only in Web3 infrastructure projects. So it's about, before I was generalist, and now I'm more specialist, and now I believe more in specialist model. So about syndicator, Cenk, I agree with Ali. So I think the minimum hygienic minimum have to be more 2 times higher than his setup fee. It's a minimum. So better if it's higher. So if like syndicator take like 10% of setup fee, so he must invest like his check have to be about 20% of the syndicate. in our we have like maybe bit special model in our community. So in contribution capital, we have two like entities. So it's our fund and it's our community. So we invest 50-50. So 50% we invest from our fund, and just only 50% we syndicate in our community. So we believe that this model is better because of it's a large check first, and second is that funds due deal. I think it's better than not every syndicator and angel can do like this due deal. And also our community will help us with the due deal, because we know we have a lot of specialists, and we know who is like Bitcoin blockchain fast specialist, who is like ETCS, and so we can understand who can help in this due deal. Also about last question, a lot of deals we source from our community members. They also help us, because it's a good when you like 2, 3, 4 partners, but it's much better when you have like 160 about people like in our community. Yeah, thank you.
Okay, thank you. Now we're gonna lead to a question, maybe do all of you, because you are active now, angels, and you have a very wide portfolio. So what would be your recommendation to have, let's say, a minimum ticket size or a minimum number of startups, especially let's say maintain the diversity of portfolio and diversity of the returns? I mean, expectation of returns are different, but there's some kind of a medium practices. So if you can share that. If somebody who just started as a retail investor, what would be like ideal initial ticket size and portfolio 10, 20, 30 startups over a certain period of time?
Is it okay if I answer or anybody else?
It's for me first.
Sorry. No. Then go ahead.
Most of you, like Europeans, applied it.
Okay, let's start, and then I think that the main thing, check you can choose. It can be $10,000, $20,000. It depends on your how you want on your strategy. Yeah. So, but the main thing that this check, it's much better when they're equal. Not like in one startup. It's in the beginning of my angel career. I do like this. In one startup, I invest like 20,000. In second, I invest 100,000. It's not a good idea. And about diversification, I think minimum 50 startups. So like in our contribution capital, so we our goal is 50 startup. I mean 50. Yeah. So if you have less, it's not good, because it's mathematics. I think like this. Thank you.
It's kind of a power of law.
Sorry?
Yeah, okay. Anybody else will comment?
Okay, I'll go. Basically, I would say that for a beginning investor, try to allocate from your free disposable like money you can spend 10 to 15% to be cautious. This is also a common rule among angels when you read Kalakanis' book, Angel, etc. 10-15%, so that you know that, I mean, there is a likeliness allegedly of about 80% that you lose your money if you put it in one startup. So with the 5 or 10% or 15, you would at least be on the safe side that you can still survive with the rest of your reserves. Of course, there's the Monte Carlo formula everybody here knows that will show that roughly after 20-25 startups, your chances of losing all your money is, I think, about 5%. So you can Google the nice little graph and with the median. So for me, it was different personally. I would say there have been times I've put 90%, 90 into angel startups, but I didn't really look at it as a systematic investor. It was my passion. I would see every angel opportunity as a Rubik's Cube that you can solve. You add your marketing knowledge and then you see growth. And it's very sexy and energy giving that you see the founders implement things and then actually having extra traction. So it was a bit of a hobby. And only after 20 investments, I started noticing that this is really like a portfolio and that you have some data points. So it also depends really on how specifically you know your niche added value. That doesn't then really depend. But every wealth advisor would tell me, Bas, you're crazy. Don't do the 90%. So if I would now look back, I wouldn't do it differently. But I would say that a beginning angel investor should be doing the 10-15% and aim to, in like 2-3 years, build up a portfolio of at least 20-25 startups, maybe in 4 years, maybe in 1 year, depends. If you do it through a syndicate, you can do way faster. And the ticket size would be around 25,000 each, or retro calculated to that 10-15%. I think even if you do 5,000 into a startup, then you could already see some sort of nice return. And the last point is, I remember this Midwest University in the US. They analyzed, I think, about 1,700 startups exits and the angel numbers, and it showed, and you can also find a few other research that shows that the IRR for an angel is about between 24% and 32%, which is way higher than the average IRR of a VC, which is actually at 0.1% if you look at the US and Europe. This is data from 2 years ago. I'm not sure how it's now, maybe even worse. But that would mean that if you throw your money out of the window, you may even have about the same results. That doesn't mean that VCs are bad, but you need to be careful where to invest, in which quartile. So that was my addition to this discussion.
Okay, what about quick comment from Adi or Dick? This.
Yeah, I would agree with Bas, and it's not it's incorrect, to talk about the minimum tickets, because it's like very personal, depends on the amount of money that you're ready to allocate. And I do agree that it's more important to say that don't allocate more than 10%, 15%. Yes, I do agree. Once you decided to allocate 10-15% of your indisposable amount of money, so then you divide it at least by 20. Would say yes, I do agree that 20 is a decent amount, to diversify your risks. And of course, once you mentioned the power law. Of course, it comes more than 50 plus. Yeah, then we do understand. But anyway, we do believe that doing these collective investments, so even going with 20 or 30 investments, anyway, we can school already do well. Yeah, and the minimum ticket, it's not important here, because everything depends on the amount of disposable money you have, starting from 10K or 25K. And also what I personally did, you divide it by 20, then you put the same amount of each company. But once you have expertise in some field, as healthcare for me, for example, yes, I did a little bit more in medtech startups and healthcare startups, because I could validate these ideas a bit better myself. That's actually what I do. Yeah.
Thank you. Now let's move on to another question, which would be you either follow the crowd, or you do your own due diligence quite rigorous, and that means that you spend a lot of time on, let's say, a team product, market, all that stuff. Yeah. Which strategy is working best for you? Maybe Murat can start, and then Ali.
Excuse me, it's huge effort. Repeat this question.
Okay, so if you are a type of investor who actually does rigorous due diligence on the deals, or you actually follow your fellow with it, it's kind of part of the network.
I think that syndicators should do very good due diligence, because if you go into blind, it's like a casino. It's, for instance, in my practice, that almost in every company we have the problem with some documents and so on and so on. Many questions, and sometimes it's due diligence. It's occupied about half a year because they should improve and all mistakes. It's very important. It means that in blind way, it's not a way. Just of course you can do it if you if in this is the same round you see the very outside good lead investor fund, for instance, or something like that. But if you are going just like a syndicator, in syndicate, syndicators would be responsible for due diligence.
Oh, yes. And what about Ali?
Yes, I think I think it is true. That's how investors follow the deal directly blindly, and some makes their own detailed due diligence. I think for me, I make my due diligence in details in this kind of syndicate deals, but maybe it is about the amount also that we are also investing. So I suggest to the investors, or if they are watching us, or someone's planning to join syndicates, if they are willing to do the more than, let's say, 3% of the overall syndicate deal in a one shot, I suggest them to make their own due diligences. Why? Because the terms can be differ if you have different levels of the investments in this kind of syndicates, or the amounts that you get as a discount level can be the case. So if they are let's say very small portion of this, and they can maybe follow the deal blindly, but if they want to do something bigger, and also if they want to grow in the syndicate investments more and more, I suggest them to do their due diligence side privately as well.
Okay. What about maybe past? Have you ever done a deal without thinking about this?
Yes. They're not thinking, but when I'm completely impressed with a person, a founder, and then just am in touch for a long time, and then this founder comes up with a new idea or a pitch deck, then there's already been so much, I would say, social due diligence that you could almost invest blindly. If it's about syndicates, I think I would at least get very positive feedback from a very trusted person, so that would already not be blind, if that answers your question.
Okay, so let's move on to the last question. So, second.
Daniel, you're muted. Daniel, we can't hear you.
Yes, right. So when we talk about the investors, what would be the top 3 metrics you look for in a company or a founder to invest in? And maybe if each of you can give me a suggestion, that would be the best.
Do I correctly hear that it's about the founder or about a fund? It was not.
No, all of it, actually.
Last question.
If you could say like a metric about the syndicate and maybe about the company as well.
Okay, maybe I can start with it, and I guess understand the question that what is the top metrics once I am doing a syndicate deal with a syndicate platform.
Yeah,
I think
for the company.
Yeah, I think the most important thing is fee structure and the alignment of the interest in the deal. This is the main thing I look. And also I look for the track record of the and the reputation of the other investors. So if there is any lead investor or someone in the deal, so I am looking to this as well. So this top 2 things is I think, the most important thing for me. So I try to understand the overall structure with the fees and the interest details, and also the reputation of the leads, if there's any.
Okay, what about Murat?
If talk about syndication platform, it's for me, it's just I see the free platform. It's AngelList, allocation, sidecar. It depends on the structure of the fee. I agree, and cost of the expenses, and of course. And if we talk about company at all, I mean that startups, of course, it's product market fit first of all, and then team, and then also it depends from the stage of the company where you would like to invest.
Yeah, I think also I agree with guys. So also I think I will add about simplicity of use, because some platforms are like much more better from UX UI, but of course the fees is the main. Yeah. And about startups, I think it's depend on stage. On early stage, of course, it's founder. So I think we have to invest in early stage in people only, because metrics, if or they don't have this metrics, or if they have, it's like could be like it could be much more less than needed, like and in this stage only founder, right? And of course product market fit, yes, but my experience say that not sometimes I see that whoa, it's working, like it seems like product market fit find it, but then sometimes it fails, so it's not like 100% also on these stages. Thank you.
Can I add to this, Daniel? Just wanted to add that in my opinion, when you invest in a syndication platform, it is very important for me who are the decision maker, who are the syndicators. So the most important thing, right? If we have, I don't know, A16Z, who are putting a lot of money in a startup, and they are asking me to join, like they put $10 million, and I put my 10,000 next to their 10 million, that's a no-brainer for me, okay? And if they allow me to put to any deal they invest in, so they make rigorous due diligence, they put a lot of money, they're very respected VC fund, or I don't know. If this syndication is a syndicate platform, is not around not around the fund, but around a super angel, super successful angel, who asked me to co-invest with him. That's a great thing, right? That's what I would be looking at, and maybe even sometimes invest blindly, because I really believe in this investor. If he or she puts a lot of money and trust into some startup, I can just follow him blindly. Sometimes I gonna like look at his investment memo and decide myself. But personally, for me, this is important. Yeah, I'm sorry.
Okay, well, that was my last question for today. I would really would like to thank you all of you guys. Obviously, for all the context, you can reach out to us, ask additional questions, and thank you for the participation. And have a good evening. Thank you, guys. And
Thank you.
bye bye.
Peter. Thank you, Janek. Thank you, guys.
Yeah, thank you all. By the way, if somebody wants to add something to this, like, I don't know, Nick, I guess you didn't have a chance to answer the last one.
About platforms.
Yeah, what is the most important metric or top 3 most important metrics for an investor who is choosing a syndicate to participate?
Okay, so let's try to answer, like not to promote what we do. Yeah, I think, of course, there are some kind of, anyway, so we are, as a community-driven, syndicate, we do believe in the power of community. And I think this is, if you're like an active angel and you want to be surrounded by the like-minded people, so for sure you like it's important thing to focus on. So what kind of community the syndicate represent, and of course, I don't know, the regional presence also I think makes some sense, because anyway, so we see a lot of trends everywhere happening in emerging markets, and so that's also important. As for platforms, yes, I also wanted to add. So yeah, there are several platforms you can use. We are as an Angel Deck, so we're keen on allocation platforms. So we did, I don't know, like 100 of deals with allocation. So we even invested ourselves to allocations, and we see what they're building as a product, and we do believe that's what we need. But I see that there are some regional, preferences. So, for example, in UK, there are some specific platforms in Europe. So even here in the region, we did some deals with the local platform. So anyway, it depends. And of course, AngelList gives you also a lot of infrastructure opportunity as an angel to invest. So there are a lot of tools. So anyway, so it's always a good choice you have. So yeah,
Yep.
That's all.
Okay, Nick, thank you. So we're now moving to the next session. I'm just moving you to attendees. No worries. Just let me see how this. Okay. Here you go. Here you go as well. So, Ron, it's a pleasure speaking to you here. We have our session starting in 4 minutes. Maybe we can start now from your introduction. So please introduce yourself. Tell us a little bit about Ron Stern. You're muted.
There we go.
Yeah.
Great. Can you hear me okay now? I'm happy also to wait a few minutes if you want to start on time, but if you want to start before, whatever is good for you.
Absolutely. Let's go ahead of the schedule.
The first pleasure to be here, Igor. Thank you for your invitation. I'm very impressed by everything that you built, and looks like amazing progress, amazing people. So congratulations for that.
Thank you.
Great. So by way of background, my name is Ron Stern. I'm a general partner and head of portfolio management in a firm called RCrowd. We're a global investment platform for venture capital investing. We are based out of Israel, but operate globally. About half of our investments today are outside of Israel, mostly in the United States, and some in Europe and Asia and Australia, and one or two in South America. We don't have any African investments yet, but we hope to get there as well one day also. We operate, myself in terms of background, I started my investing career back in 2002 with Shamrock, which is the Disney family investment arm. Worked there as a partner for 7 years, then left Shamrock in 2010 and started scouting and working with U.S. investment firms. I brought with a partner, Kleiner Perkins, to make their first investment in Israel, and then worked with a few other investors, became a representative of the Pritzker family, And then for a 2 years period, I moved from the investment side to the operating side. I joined a small software company doing AI for online marketing. Company grew extremely fast, and we were able to go straight from bootstrap to IPO without raising any venture capital along the way. We took the company public on AIM, did that for a couple of years, and then joined John Medved at our crowd about 6.5 years ago to run our portfolio. My role within the firm is I'm responsible for our global portfolio of all of our direct investments. We have, in addition to our direct investment business, we have a funds business that we invest in funds as well. But on our direct investment side, we've invested in over 400 companies to date, probably upwards of about 800 investment rounds. And we currently have a portfolio of about 250 companies in which we have board seats and representations in most of them, and try to be as active an investor as we can. So that's a bit of background.
Okay, great. So, and we're absolutely exactly in time to start the session.
Sure.
Okay, so let's start from your journey. So please provide some insights to our crowd. What it is, a VC fund or a syndicate. So what does the firm do? How it works?
Sure. So we operate as a VC fund in the sense that we have an investment team. We go out to the market. We're very active in seeking engagement with entrepreneurs and with companies directly. We lead most of the rounds, lead or co-lead most of the rounds that we invest in. We give our own term sheets. We don't, typically join. Sometimes we can join an existing round as well. But, our more typical investment is to go in there, structure a deal, lead a deal, and then invest. Most of our investments, or maybe almost all of our investments, I would say, are primary as opposed to secondary investments. So, bringing in new capital to the company. And in most cases, we get to nominate a director or observer to the board and have enough holding in the company to create, certain investor rights and also provide some influence and guidance to the company. So in that sense, I would say both in terms of how we operate on the front end and then how we manage the companies after we make the initial investment, we're operating much more like a traditional fund, I think, than a syndicate. So that's basically the answer there, if that answers the question.
Okay. And when you and I discussed this, like the other day, you mentioned that our crowd actually started as a syndication platform back in the day, and then evolved. Can you please share some story of how the firm developed from a syndication platform to what it is now?
Sure. So John Medved, who started the firm in 2013, was a venture capitalist, actually one of the first venture capitalists in Israel back in the late 90s with a company called Israel Seed. And after doing venture capital for a few decades, he realized that this is a great asset class to be in. Historically, venture capital has done better than any index in any, market or debt or equity or anything that you compare it to, which is why the smart foundations in the world, the big universities and so forth, over-allocate to venture capital because of those historical return profiles. But the problem with venture capital, John found, is that it's actually very difficult to access this asset class unless you're very close to the venture capital community. So unless you're a huge pension fund and you have access, you have relationships that you've built over decades, then, it's no problem for you to access the asset class. But if you're a wealthy individual or family office or even a multifamily office, sometimes you find it, very difficult, nearly impossible you can always make an investment. Like your cousin can always come to you and ask for, $100,000 and you can make a check. That anybody can do that. But if you're looking to make an investment in a structured, curated, responsible, professional fashion, that's very hard to do unless you're, a gigantic pension fund that can deploy significant amounts of capital into a professional fund. So the vision that John had was, what if we could create a platform that would provide access to individual investors, accredited investors, and families? And it was just as the regulation around this was evolving and starting in the United States. And what if we could invest as professional investors on the front end, just like a regular venture capital fund, but on the back end, allow individuals and families to join us in the same terms, in the same rounds, exactly like and side by side in many cases, with other professional venture capital firms as well. So that was the idea. In the beginning, it started very small, getting into rounds with hundreds of thousands of dollars from, whatever, a dozen or 2 dozen, 3 dozen individual investors, each writing a $10,000, $20,000, $30,000 check. But the thesis proved itself, and very quickly this grew, to many thousands of investors, some wanting to come in very early, some preferring to come in with larger checks a lot later in the life cycle of companies. And so, as that was happening, we turned into leading much more rounds, setting up the terms, bringing in other co-investors with larger checks, larger percentages of the round and later stage investments as well. So, I think it started, as you're saying, probably more looking like a syndicate, perhaps, but with every intention very quickly to turn it into, a professional venture capital platform, which is what John was able to do very quickly.
Wow. Looks like we're doing the similar thing, actually.
Fantastic.
Yeah, I mean, I didn't know. So it is it a more a syndicate or it's more a VC fund, like our crowd? I hear you saying it is more a VC fund, right?
Yeah. So, I think it depends how you categorize syndicate versus VC funds. In my mind, a syndicate is a platform that enables you access into a deal. It could be access into a very great deal, but it pretty much, in my mind, sort of ends with the access, meaning you're usually not determining the terms, but you're joining, somebody else who's determining the terms, or you're coming into a secondary. And post-investment, you're usually not very involved and influential upon the company. In many cases, syndication groups, they'll come in and they'll have a piece of an SPV that invests in the company, and sometimes even the management won't necessarily have a direct relationship with the syndication group. So in that sense, a venture capital fund is something that I see to be a lot more active, both in getting the deal, negotiating it, creating the investment opportunity, and then also on the back, post-investment, creating a lot of value and being very involved. We, just like any other VC fund, when we need to, we come in and we make changes in management if we need to do that, or, collaborate with other VCs and investors on the cap table to change the direction of a company, or help it raise additional capital or, create new products, merge to other companies, everything that has to do with exit and so forth. So in my mind, the difference between syndicate and fund is a lot has to do with your level of involvement, in how much effort and time and capital you're spending on that. The other thing is the ability to commit capital. What happened to us after a couple years of doing this is that a lot of our investors said to us, we love what you do and our ability to pick specific companies to invest in. That's really great. But, we don't have the time to do that. We don't have the expertise to do that. We'd like to just give you a lump sum and have you invest it on our behalf into a specific strategy or into multi-strategy. And so we created funds. And today, significant portion of the money that we raise and significant portion of the money that we invest actually comes, from dedicated funds that we raised and that we're raising. And so in that sense, also from a capital allocation standpoint, we are operating a lot more as a regular venture fund than we did maybe in the early days before we had this ability to invest committed capital, if that makes sense.
Yeah, absolutely. It's a good question to think about. The actual difference, in my mind, the difference between syndicate and the syndication platform and the VC fund, it is more philosophical view, right? It is when you trade money for your time and efforts and expertise. Like if you have a lot of expertise and time, you can invest wisely, you can choose deal by deal, but you're gonna become a mini fund yourself, right? You're gonna make 30, 40, 50 investments in several years, meaning that it is your full-time job doing this. Okay, you're a business angel, super angel, good for you. If you do not have so much expertise all the time, both of them, you select somebody who manages your money, you give them the money, more than you would invest, right? But more than you would invest, say, deal by deal. But they manage it. They take management fee, of course, and you trust them with your money, but you trade it for your time and efforts, and you go and make more money on what you're doing and invest, give money to other VC managers, etc. That's a difference from the investor standpoint.
Yeah, and I think also that's one very important difference, Igor. I agree. And I think also your level of influence in the companies is also could be a difference because, you could be the world's biggest expert in a particular field, but if you only own 1% of each company you invest in, you're not going to have a lot of influence. I mean, you might have some good ideas, and those ideas might benefit the companies, but you're not really going to be able to intervene. And then people paying you for your services, I think in the most part are also paying you management fee and carry, or at least paying us management fees and carry, with the expectation of us to be very hands-on on our companies and, to make sure things are going the right way. And if not, to intervene. And you need to have a position in order to do that. It's very hard to do that without having, significant stake in the company or very good relationships with other investors that have a significant stake in the company.
Yeah. Moving forward, as far as I understand, within our crowd, from time to time, you might invest in one deal from a VC fund and a syndicate at the same time. I believe this happened with Siabra, our own company that we co-invested, right? And not only them. So this comes to this question. It is a form of a hybrid fund, right? When you have a VC fund that manages somebody's money and can put more, and you have the syndication collecting money of individual retail investors. So do you believe that this sort of a hybrid fund is the future of VC as a system, of VC as a VC capital, right? Of how the capital is going to be managed in the next 10, 20 years.
Sure. So I think certainly traditional VCs are here to stay, and they're doing a great job. And I have no problem with that. We work very well with them, and we think we're a very good addition to a cap table, and we believe that the cap table should have, of course, also traditional VCs. But what I would say is that pure syndication platforms, in most cases, I think the good ones are dependent on specific VCs they're working with, because they come into the SPV of the VC, and then they enjoy all the benefits of being associated with a VC. So, for example, if the VC has a board member, if they have preemptive rights, if they have anti-dilution protection, if they have ability to influence the company. So if the syndicate is part of that group, like we have done, as you mentioned in Cyabra for one example, then I think that creates a big benefit to the syndicate. And it also creates a big benefit to the VC, because now the VC can come with a bigger stake. Maybe he even has an opportunity to offer down the line secondary transactions within the SPV that could benefit, the earlier investors and allow new investors to come in even when there isn't around. So there's a lot of benefits that can come from this collaboration, which is why I think it's going to grow in the future. And we as a platform, we're very open to doing these kinds of collaborations, because we're set up to do that for day one. It's not off our strategy, it is our strategy. So we're very happy for the collaboration that we have with you and the example that you mentioned.
Yeah. Okay. Cool. So speaking of this hybrid model, what benefits, in your opinion, this model can give to these retail investors?
To which investors?
Retail investors. The investors who, under retail investors, those who have not so much money, maybe $10 million net wealth, maybe $15 million net wealth, and they can put a couple of $1 million in the venture capital, and I believe they might benefit of this hybrid situation, right?
Yeah, absolutely. And I think the challenge when you have $1 million or even $5 million to invest in venture is, we're very strong believers, and we say this all the time, that winning in venture is all about, obviously choosing the right partners and the right companies to invest in. But it's also about diversity. Never put all your eggs in one basket in venture, because a lot of times, even if it's the best technology in the world and the best team in the world, you might be losing the market. A competitor might come in and do something that you didn't expect. Regulation might change. So particularly with these young companies, you need to invest across a number of companies in order to be successful. And that's what the data proves globally. And that's what our own personal data, proves very nicely as well. So you really, if you have a couple $1 million to invest in venture, you're really writing, hundreds of thousands of dollars checks into a bunch of individual companies. And at that point, you usually if you're going in alone, even if you get access, which is very hard to do, it's almost impossible to do a good job if you're trying to do it on your own for a few reasons, Igor. The first reason is companies don't have time to deal with investors of, 0.25%, 0.5% in the cap table. They just don't have time to manage it. It's not like a public company where you can own 0.0001% and there's an IR department and you can talk to them whenever you want. I mean, these are very, they're very thin on resources. So that's why it's going to be very difficult for you to go into the good companies, and you'll end up investing in the companies that don't have a choice, but have to take a $250,000 check from someone. So that's number two. That's number one. And number two is usually all the rights in a private company come with a minimum threshold. So the right for information, the right to be protected in a down round, anti-dilution, the right to go invest in up rounds, the preemptive right, all those rights, come with, and then the other benefit is, and this is not just about our crowd, it's in general investing through, professional investors, is that you have somebody, with a lot of experience, a lot of scars usually, who is looking after your capital and your investment, and has the experience to make the maximum out of that investment in that particular investment in a company. So I think that works very well together. And people, I believe, if they're interested to invest in direct companies, they should look into platforms or syndicates that can help them, get there.
Yeah, cool. I don't know. Let me maybe address this this one, because we spent so much time today on discussing the way we see and invest, right? And how to choose the VC, etc. But we never touched this base of where to invest. And I mean, definitely, I think a lot of these trends. Like your GP at our crowd is like a great. It's a big deal, right? 2024. Well, what is in your view? What are the top? I don't know. Whatever you want to mention, top whatever number of industries you are looking at in 2024, because I'm so eager to know this. Where should I look at?
Sure. So this is just my point of view, and I'm not giving investment advice. Everybody's entitled for their point of view, but I think something very dramatic happened in the world last year, which is ChatGPT, and it's not that AI didn't exist before ChatGPT, but I think it turned the attention of a very large part of the population to the possibilities of AI, and made AI in that sense a lot more transparent and understandable by the masses. And I think that is creating a tremendous opportunity, and obviously tremendous investment that's going into AI, and it's changing a whole bunch of industries, right? I mean, AI is a technology. You can see AI in transportation and in medical and and of course in military and defense and in communications and service companies of all kinds of sorts and SaaS and so forth. And so I think when we're looking at companies, and this started before ChatGPT, but it's probably even more enhanced after, we're expecting to see how they're applying AI, in their business where it makes sense. I mean, everybody's sort of adding AI to their name now. That doesn't really impress us very much. But if it's a business that should be using AI to create the next product, the next service, then we of course expect to see that in the company. And if not, we ask ourselves, okay, so if this company doesn't have it, then how long are they going to have a competitive advantage? Because ultimately, somebody's going to be able to come and do that if they're not already thinking about it. So I think that's probably the biggest kind of cross-sector cross-industry technology that's having an effect on venture these days. The other, I would say, from a completely different standpoint, is the whole idea of climate tech. And climate tech, for years, I think was an underserved, underinvested market. Had a peak, a couple years ago after the Paris Accord, and now there's a little bit more of an awakening there. But I think the world is moving way too fast into a place that it would be very hard to reverse it. And a lot of people are concerned. We're probably a couple years away from climate companies really having, unicorn outcomes and being able, beyond Tesla, of course, but really being able to show very big returns. But I think there is a lot of investment, and for patient capital, there are some very interesting technologies around climate tech that, I think merit an investment in 2024 to then be, reaped in at the end of the decade. Because I think between now and the end of the decade, the investment in climate is really going to probably grow more than any other sector except maybe AI. That's sort of the two main things that I'm thinking, at least.
As advertising, I would add to this set Web3 to be the three like important technologies, because in my understanding, like AI and climate tech are, that's like a super awesome and important thing, and they change a lot in people's lives, and so can do Web3 as a new financial landscape, right? For people, because it is a new way you look at finance, at money, in the last, 1,000 years, right? So it is also, that's why we pursue this. We just believe in it. I understand, like, nothing in climate tech, something in AI. I invested in the AI, several AI companies out of my previous fund. And we co-invested with you, by the way, in a couple of companies in Israel as well. So that's a great stuff, and it's here to stay, as well as Web3, as I believe.
Yeah, no, I think Web3 is probably even ahead of climate in terms of the immediance of it, right? Because Web3 is already here, and certainly growing at a very fast pace. And I think smart investing in Web3 is a very, very, very much needed and very much a focus of a lot of companies today.
Yeah, indeed. So I have no further questions, and we almost in time.
Fantastic.
Several minutes ahead of time, so we're good to go. And I don't know if you have anything to add on. Go ahead.
Well, I think you built a very, very interesting platform, and it's great to collaborate, and having people like yourself in our network just makes us a lot smarter, and creates a lot more abilities. And thank you for the opportunity to speak here today. I really appreciate it, and great to be on your platform.
Thank you, Ron. See you.
Take care.
See you.
Bye-bye.
So, everybody, we have a 2-minute break, and then we're gonna have the last session in today's conference, and the speaker being myself now, which I mostly appreciate. So the so-called workshop on how to choose a VC team wisely. So 2 minutes to go. So it's a time. So let's start, and I guess we need 10 or 15 minutes for this. So, ladies and gentlemen, you know that investing in venture capital isn't just about numbers. It is about building lasting relationships and fostering genuine chemistry with the venture capital. Us, the guys you partner with, the guys you give capital to manage, right? Yet, how do you gauge this chemistry when faced with only a handful of meetings? Because before giving me as a partner money, you spend, I don't know, 1, 2, 3 meetings with me, like several hours, and then you're gonna decide whether to give me the money or not. So no way to build up some lasting relationship in this 3-4 hours, right? Now I'm gonna give you a cheat sheet, a shortcut to uncovering that elusive connection, right? The top VC funds have mastered this art by engaging with their audience through non-profit, content-rich initiatives like personal blogs, podcasts, educational programs, etc. By immersing yourself in these projects, you gain invaluable insights into the VC team's approach and approach, allowing ample time to discern if the chemistry with a partner is indeed present. For example, let's look at, I don't know, A16Z or Andreessen Horowitz, a crypto startup school. Okay, it is a 10-week program tailored for Web3 startups. And the school offers in-person lectures, mentorship from industry experts, and access to Andreessen Horowitz network. And you can attend the sessions in person or online. At A16Z school, partners of the fund lead lectures. They also host fireside chats with industry experts or startup founders, and they run workshops. So they cover topics like I just checked today's morning. They cover topics like zero knowledge technology made simple, Web3 pricing and business models, or decentralized networks and why they matter. Like pretty technical and deep topics. For example, one notable partner of A16Z, Chris Dixon, a very famous person in crypto world, shares his expertise there on this lectures courses. By the way, he was ranked #1 on the Midas list in 2022. It's a very prominent rating of venture capitalists. And still, he spent a lot of time and efforts on this non-profit educational program. Another example is a blog by Union Square Ventures, a very famous fund, and it's Fred Wilson. Fred Wilson is a legendary figure in venture capital world, and he covers topics like read, write, own, about Web3 and blockchain tech, like Empire of AI. It is about building an AI school, AI institution in New York, or CEOs, 60. This is an article about how to discuss performance of a CEO on the board meetings in a startup. Okay, all of this is about VC specific topics. Yeah, of course, many other VCs also do blogs like Fred Wilson. It's very popular one. last but not the least, podcasts have also gained popularity recently. For example, Acquired is my favorite. Acquired is a particularly insightful podcast hosted by Ben Gilbert from Pioneer Square Labs and David Rosenthal from Kindergarten Ventures. These two guys, they dive deep into the histories and journeys of top-tier startups from the very beginning, from the founding point of these startups to the success, to the time they become unicorns and then very large companies. And Ben and Devin, they discuss all the valuable insights and very, very difficult steps founders make when they develop the startup. So all of these platforms that I mentioned, like A16Z, Union Square Ventures, and the guys from Acquired, these platforms offer you windows into the mindset of VC partners, paving the way for authentic connections to them, right? So when I listen to some podcast or some educational course, I start to understand their mindset, how they think, and that's a very important way how to get closer to the people who want to manage your funds the next 5 or 10 years, right? I got to confess, I'm not trying to be a big shot like X16Z or Union Square Ventures, but I still want to share our cool initiative with you. I mean, Contribution Capital. Here at Contribution Capital, we are all about learning and connecting people. That's why we've set up a Web3 school just for accredited investors like yourself, right? And our goal is simple. We want to educate you and help you make meaningful connections and understand how the industry actually works. So here's the deal. What we've done, we have split a Web3 industry into 24 different sectors and picked the biggest public company in each sector. Our year-long course consists of 24 meetings held every 2 weeks, hence 24 sectors, right? At each session, we dive deep into one sector, and doing just a real investment committee, where we pretend to invest in this public company. So 24 sectors, 24 public companies. We take one company and pretend we are investing in this company and run a so-called investment committee about this given investment, right? We cover everything you'd expect to be covered on a real VC investment committee. So we consider the company's underlying technology, their product, discuss their team and team background and team composition in this company. We discuss the market sizing, the competition and competitive landscape overall, the financial stuff, the 12 months roadmap, and the long-term vision of this startup. So in just 60, 90 minutes, you're going to get a solid grasp of the sector based on a real-world case study. So stick with us for all 24 meetings, and you're going to know Web3 inside and out. Trust me, you'll be in the top 0.1% of investors. And also, you got to know me better than my wife does. So whatever. This is the whole point of all of this. You're gonna understand who am I, how am I thinking, how am I solving and cracking this investment deal, and how can I make decision, right, based on what? Because I'm doing the same thing when I'm investing in real companies out of my fund. like what I show on this course, right? In conclusion, let's remember that in the realm of venture capital, chemistry is paramount. I mean the chemistry between investor and fund manager. By leveraging these cheat sheets, I mean this courses or blogs or podcasts by top VC funds and engaging in initiatives like our Web3 school, you empower yourself to make informed investment decisions rooted in genuine connection to money managers. So my my recommendation to you is to look for VC teams that are ready to share their expertise in an open and transparent way. Actually, many of the existing funds or syndicate teams, they have something like that. So look for that, and good luck in your investment decision. I guess that's it for today. And thank you, everybody, who attended the conference. That was a pleasure speaking, and that was a pleasure hosting this conference for you. Thank you and good luck.